Good morning, everybody. As you'd know, just finished the reporting season for 3 of the 4 banks and CBA also with its third quarter trading update. Produced some fairly detailed notes for you to go through if you're so interested with our forecasts, etc. within them. But look, let me just touch on the very high level points, I suppose you could say, coming out of those results, the way that I'm thinking about the drivers going forwards and just my investment views at the moment. So first up, just in terms of what happened during the first half, I've cut this into positives and negatives for you. So first up, the positives, look, credit growth continued to be fairly solid, if not fading away. Now, what we should expect going forwards, look, higher interest rates, absolutely we should expect credit growth to be declining. What I'm talking about here is system growth when we actually cut it through into the different banks. CBA's been talking about how loans were getting written below cost of capital, but nonetheless still had some very strong growth coming through. ANZ have certainly picked up their growth rates, and on the call they referenced how there wasn't necessarily them having the lowest prices, but certainly servicing the mortgage element the broker element very well, particularly with improved processing capability. And also just keeping their policies sort of on the straight and narrow. What we also saw there is NAB certainly was holding back from chasing the market, and Westpac certainly didn't have a hell of a lot of growth going through. On the net interest margins, and as I've said before, remember like a 5 basis point movement on this net interest margin, it swings EPS by, let's call it something like 5%. So very important. What we saw is first quarter uptick, so really nice to see because they're getting that NIM leverage coming through from the higher rates. And then in the second quarter, we're starting to see the pressure coming through. So we're actually starting to see the NIM then starting to actually trend down. So look, that's all about competition on loans. And like a number of the banks called out of how it wasn't just the front book, i.e. new loans, but it was actually this intensity of competition in terms of retention pricing for their back book or their existing loan book. And also what we've seen, which has been a little while coming, has been like this intense competition to do with the deposit side of things. So that impacts their cost base, remembering that deposits are quite a material proportion now of their overall funding. So just something to think about there on the NIMs. Certainly looks like they are trending down. ROE, so you've heard me talk before about how the bigger the spread between the ROE, the return on equity, and their underlying cost of equity is, the more value they create for their shareholders. Certainly with that higher NIM on average through that half, their ROE certainly jumped up to levels that we haven't seen for a little while. I think the really sort of big positive that came out even going forwards for the banks was their regulatory capital. So that's this CET1 or Common Equity Tier 1 capital ratio. That has stepped up quite significantly. So that has come through from both organic growth, organic capital generation, but even more importantly, there is a new APRA, a revised capital adequacy framework that came in place from 1 January, and it helped out the banks. So what it means, and you might have seen the email that I sent out earlier this week, what it means for the banks is that they have significant surplus capital over and above the target that they are setting themselves, and I think what APRA is really setting them, which is a minimum CET1 ratio post paying dividends of at least 11%. So they are well above that level. That means that they have capacity to either weather a harder landing, economic landing, than what might otherwise be thought is coming, or to fund growth, albeit, we're looking at slowing credit growth, so maybe not as much growth as what we'll expect, or to do capital management. And look, it's certainly you've had NAB saying, hey, we're just holding off on any more buybacks for the next quarter, just seeing how the data comes out in terms of system stress, etc. Westpac, they push their decision-making out on that front through to their full year result in November. But that's the sort of thinking it should be thinking in terms of potential for buybacks coming forwards. Provisions, look, this is provisions for loan losses. They certainly look strong. Certainly they have provisions that are well above their base case levels. And those base cases, when you look at the economic assumptions sitting behind those in terms of unemployment and property price falls, you kind of go, okay, they've set up pretty well here in terms of their provisioning. On the negative side, look, the NIMs I've talked about already, they're up and now they're heading down, so not so good. The cost outlook, these banks have done a really great job over time being able to take costs out of their business through investment in technology, so to offset inflation. Services inflation now, which is particularly important for banks, is running very hard. It is hard for these banks to actually counter that. So you've seen the likes of Westpac stepping away from their cost target, and other banks sort of, you're looking at like the ANZ 5% sort of cost growth coming through. So really hard to keep a sort of a flat cost base in that environmental economic context. Early signs of system stress. Look, it's pretty hard to detect really, but certainly they're coming off very low levels and just starting to edge up. I like to think that I've got that covered in my modelling through the fact that I'm assuming that loan loss rates actually increase, normalise higher up over time. That gets caught up in my valuation, but certainly something to watch for, particularly if the economic environment gets a lot tougher than we're hoping for. How to think about things going forwards. This is and this chart sort of comes up in a different colour to what I had it on in my screen, but this is a chart you might have seen before, thanks to Jake, who's an intern in our research team, who's actually managed to make this look a hell of a lot better than what I could have. But just like to sort of break your thinking into 3 or 4 buckets there. So earnings, what's happening with the book value, their equity, what's happening with ROE, shareholder value. And then further down the page, which is also important, is this regulatory context. So on the earnings front, on the left-hand side, right? So the P&L there, you can see net interest income plus your non-interest income following down with OPEX, credit impairment charges, etc. Look, the biggest element here is, let's call it 80% is the net interest income. The 2 biggest drivers are what's happening on the interest revenue and on the interest cost. So interest revenue, what are we seeing? Interest earning assets, like I was saying before, that's mostly loans, and also I should say investment and liquid assets. We should be expecting that starts to slow down. The yield on the interest earning assets has been heading high because of the higher cash rates, but the intensity of competition has been sort of slowing that down. They're not getting the full cash rate pass-through coming through. On the funding mix side, so certainly the mix of deposits to overall has stayed relatively constant. But within that mix, the at-call versus term deposits, that's actually going against them. So more and more money going into term deposits. Term deposits are obviously more expensive than at-call, and the term deposit rates themselves are going up. So that funding mix is going against them. And like I was saying there, just the cost of term deposits, wholesale funding, not so bad. But certainly the refinancing of the RBA's term funding facility is a headwind also. So generally expecting, if you can look at those arrows that I've got there, when you sort of combine all that, the net interest income to be coming down from the peaks that they've been in the first half. Non-interest income, so this is it's far more volatile. There's lots of stuff thrown into here. Far more difficult to predict, but generally in a stronger economic environment where there's a little bit more uncertainty, this line item improves. We saw that actually kick up in the first half. So I think that generally speaking should be looking a little bit stronger. Operating costs, not so good like I talked about, so red arrow upwards. And the credit impairment charges, I'm assuming that they actually go upwards also. So overall, I think the direction of earnings, at least in the short term, is downwards. When we look across to the book equity and what's going on there, so effectively book equity grows with profits, decreases with dividends, decreases with buybacks, increases with equity issuance. Look, I don't think there's much likelihood there's going to be equity issuance from these banks. They are, really well capitalised. The buybacks, certainly, I think the potential for those is improved. The dividends, look, what I'm assuming here is that the dividend that they set for the first half, they think that that's sustainable. They have set their dividends with a payout ratio generally towards the bottom end of their payout range. So what we can think about here is if earnings decline, I think they will hold their dividend and see their payout ratio move towards the middle to upper end of the range. Hence, divvies should actually, I think, be sustainable. So overall, on the sort of, I suppose, the right-hand side, when we pull it all together there, generally speaking, I think probably just a weakening in terms of the shareholder value creation side of things as we go into this tougher economic environment. So going forwards, investment views, look, haven't really changed a hell of a lot here. I like to split these banks into those that have probably got a little bit more of a tilt towards business banking versus retail. And let's not forget, all these banks have quite a concentration into that retail banking anyway. CBA, still think of that as the highest quality bank. It still has the highest ROE, best cost of equity, Technology's the best. It's got a leading retail customer scores, and I think there's really something to be said about that very sticky retail investor base. Westpac, look, I've still got an ad, but I've got to tell you, it's probably less conviction ad, and because part of the story here was a really strong improvement in the ROE that was partly coming through from that ability to hit their cost target they'd set. The resetting or the stepping away from that cost target takes away a bit of that conviction on the upside. So certainly I'm still got an ad on it, but the conviction there is a hell of a lot less. What really stands out is, gosh, it's got a similar business mix to CBA, but the trading multiples are just a hell of a lot less. The yield is a lot higher than CBA. So just like to see them start to get some market share gains, getting some runs going through on the scale they've got in that retail side of the business. NAB, this is another one where I was looking at and I was going, look, I've got a hold on it, but actually I'm sort of feeling a bit more positive towards this one. And I'm feeling a bit more positive towards ANZ too. The thing that kind of holds me back on both of these, well, for both of them, in a weaker economic environment, generally it's the business banking element of these banks that gets hurt first before the retail does. So that's the bit that sort of holds me back. ANZ, look, the one that stood out about it, I think, that they really sort of pursued or tried to promote within their result preso was, their institutional banking element. It's very strong. And what they're trying to say here is, hey, this isn't as much driven these days by true lending. It's actually driven by the exposure they've got to payments and FX platforms and processing. And that's really high ROE, low capital deployment type stuff. So it's a story which is a little bit different. And I think this is where they're heading when they set up their non-operating holding company structure, where they want to put more capital into this unregulated, more platform payment processing side of things. And it's the thing also that sort of concerns me and holds me back from being more positive on it, because I just don't know where that capital is going to get deployed and just whether we're going to feel comfortable with it or not. NAB, look, to me, it's the one that's got the leading SME relationship banking franchise, so should be less pricing pressure on that side of its book. Attractive yield, very keen on doing buybacks, just holding back at the moment. So look, generally positive. It's just that its multiples are a little bit higher than what the other smaller three are at. So that's where I'm at on those guys. Look, I've got a table here that you can sort of have a very quick look at when you get back to your desk in terms of just the investment summary, where targets are now, how I've moved them around a bit. Just all the different multiples. So obviously the reds are the bads and the greens are the positives on each of those sort of key elements. So I'll leave you to have a look at that. And then down the bottom of that page too, I've got the key dates for dividends and next reporting. So that's it for me in a nutshell. Any questions, please fire away, or I'll be around today.